Today we'll talk about someone who is interested in a whole life insurance policy. He primarily wants to be able to grow his cash value, and he's interested in funding a policy for up to 20 years. Now, he has done a lot of research, and he listed out what he was interested in. He said, I don't want a high death benefit. I want the highest long-term cash value that I can possibly attain. If it means giving up a little bit of cash value up front, I'm okay with that. A long-term care rider would be beneficial. I'd like to have that. And flexibility is very important to me. So what I'm going to do is go over the different companies and products we showed him, and I'll also add some talking points that I provided for him with the goal of helping you refine your decision-making process when it comes to picking the perfect whole life insurance policy for your situation. I'm going to pretend you're him. So again, he's interested in growing cash value, and premium flexibility is very important to him. I'll explain exactly what that means. But to kick things off, the company choice. There's a lot of life insurance companies out there. He's interested in your four major mutual companies, who are MassMutual, Guardian, New York Life, and Northwestern Mutual. The reason why he's interested in these companies is because when we look at whole life insurance policies that have lived the test of time, meaning not illustrations, but real policies, we've seen those companies deliver, in many cases, the highest returns on cash value and death benefit long-term, meaning they're actually delivering, not just showing good-looking numbers on paper. I'm a big fan of them for that reason. Also, when you look at corporations who take out whole life insurance products, they're often looking at those four companies. Not saying other companies are bad, we've just seen a lot of proof of performance with those four. We'll focus on MassMutual and Guardian. So with a whole life insurance policy, if cash value is your goal, what's very important to add to a whole life insurance policy is a term insurance rider, but most importantly, what is called a paid up additions or PUA rider. MassMutual has two different forms of a PUA rider. One, they have what is called their AILR, which stands for Additional Life Insurance Rider. There are several different forms, 3 forms to be precise, with MassMutual of AILR. And then also their LISR, LISR, which stands for Life Insurance Supplement Rider. Typically, I like to use a combination of AILR and LISR, because if you set it up right, you can easily adjust your total PUA payment one time per year, every year, provided it's on your anniversary date, which is a fancy word for your premium due date, without medical underwriting. So what that means is if I wanted to pay in 10 grand this year, and then 30 grand next year, and then 20 grand the following, I can do that. And we can just let MassMutual know, here's how much we'd like to fund this year. Doesn't need to be set up right with those riders though. Otherwise, it's not going to work like that. Now, the nice thing about MassMutual in his particular case is that he's interested in funding a policy for up to 20 years. MassMutual is extremely accommodating when it comes to getting a policy where I want to fund for a long time, 20 years for example, and have a very, very low base premium. Why that's important is because when you look at a whole life insurance policy, money can go toward the base premium or the PUA rider. Base premium dollars often take the biggest bite of cash value up front because they satisfy the cost of the life insurance. So I want to minimize that base premium. What can be challenging with a lot of life insurance companies is to carry a very low base premium and have the ability to fund for a long period of time, like 20 years. With MassMutual, it's possible, and I'll show you exactly that. You can actually still get a 10% minimum premium and fund for 20 years or longer if you wanted to. Guardian, on the other hand, when it comes to adding money toward PUAs, extremely flexible. With their PUA rider, you can literally go on your online account, mobile app, and send in an ACH payment from your bank account to your whole life insurance policy, and it typically hits your policy 1 business day later. So I can just dump money into PUAs at my discretion, which is nice. The most I can fund is typically up to the MEC limit, and I also have to follow the Guardian PUA rules, which I would check out this video here if you'd like more information on that. But extremely flexible, especially when we compare them to MassMutual, where if we set it up correctly, we can adjust our PUA payment 1 time per year. They do have a rider where you can make up to 3 PUA payments per year. That's Mass. But Guardian, it can be multiple times per week if you wanted to. So they're very flexible when it comes to their PUA rider. Here's the drawback though. If I'm looking to fund a policy for 20 years, they're not going to be the most accommodating when I look at them. I have to attach a very large term insurance rider. And one of the things he expressed is that he wanted a minimum death benefit up front. So what that means is when he compares MassMutual and Guardian, in a specific case where he's funding for 20 years, Guardian's going to have a very high death benefit. Doesn't mean it's going to cost a drastic amount more, but it will be higher. So it's important to understand exactly why. So what he wants, a minimum death benefit. Number 2, maximum cash value during the later years. Now, what he mentioned is that if maximum cash value in the later years means that I have to have less liquidity up front, he specifically said, if I have medium liquidity up front, meaning I'm willing to take a loss early if I can get more long term. If that's necessary, he'll do it. It's not always necessary. However, it's important to understand the ins and outs, and it's important to really be careful when you say that, because it's a great way to walk into a trap where you can just absolutely get taken advantage of. And I'll explain how that happens in a little bit. But he wants maximum long-term cash value. Living benefits is important to him. What this means is he wants some type of long-term care, but if he doesn't have to pay for it, meaning he doesn't have to attach an actual long-term care insurance rider, that would be ideal. So when it comes to a free living benefits rider, which is also referred to as a chronic illness rider, if we look at MassMutual and Guardian, MassMutual does not offer one. Guardian does. It's referred to as their EABR, Enhanced Accelerated Benefit Rider. It is a chronic illness rider. It's a form of living benefits that allows you to access a percentage of the death benefit if you are diagnosed with a chronic illness. The funding, here's what he's interested in. He said, for the first 10 years, I would like to fund a policy with a minimum of $25,000 per year, but a maximum of $75,000 per year. And then the next 10 years, years 11 through 20, I'd like a minimum of $15,000 and a maximum of $50,000. So the first thing I want to say here is I appreciate this so much when someone provides details as far as what they're interested in. Shows they've done the research. At the same time, going back to point 2, where we mentioned it's important that when you make a request like this, you understand the ins and outs, which is tough unless you're in the business, because you can walk into a trap. Here's what I mean. The rules of the game. If you tell an agent that you want a minimum of $25,000, there's a high likelihood, in my opinion, that they might set the base premium at $25,000. In a case like this, where you said, hey, I want to fund for 20 years and the minimum is eventually going to be $15,000, well, then there's a high likelihood they might set the base premium at $15,000. Now, with a life insurance policy, money can go toward the base premium or toward your PUA rider. Base premium dollars do not build cash value in the first year. Sometimes it's the first and second year. PUA dollars do, which is why people are happy when they put money here. All right, that's my not so good smiley face. The base premium and PUA depends on the insurance company as far as how aggressive you can go. If you look at Mass Mutual and Guardian, wherever you set that base premium, both of these companies will allow you to put 10x that amount into PUAs. Meaning, if I set the base at 7,500, I can actually put another 75,000 into PUAs per year. So it actually set the base at 67.5 and change, and then set the PUA at 67,500. So when I add the two together, I'm at $75,000. But my point is, knowing that the base does not build cash value up front, and I have to commit to that dollar amount, because he said my minimum can be 15K, I'm not going to set it there. Meaning I wouldn't want someone to do that to me, because that means they would make more profit, but at my expense, because the premium doesn't build cash value. Now, if he said the most I might want to pay in is $150,000 per year, okay, that higher base can make sense though. But you can carry a base premium of 7,500 and still fund a minimum of 15 grand. Like, that's very easy to do, and I'll show you that as well. My point is, it's important to know the rules or just be able to trust the person that you're working with. And there are groups that would set it up in the way that I just explained. But it's important to be aware of that. I would not, again, set the base premium at 15,000. Because for me as an agent, I could say, well, your minimum is 15,000 now. That's your base premium. No, that's me using my knowledge to take advantage of a situation so I can literally make twice as much as I normally would if I just set it at 7,500. So let's look at the illustrations quickly. We're going to look at two different Guardian products and then one Mass Mutual product where we fund for 20 years. So he said he's got a range of 25 to 75,000 in the first 10 years and then 15,000 to 50,000. What I would do in the illustration is build it in a manner where it's tested to be able to handle the full dollar amount. So if he thinks the high end is going to be 75K per year for the first 10 years, even though he might not pay that, that's the amount I want to make sure the policy can handle without triggering a MEC. The same is true for the next 10 years. If he pays him less, I know the policy can handle it no problem. If the policy can't handle it, well, then I've got to make some adjustments up front before he starts it. So 75 for 10, 50 for the next 10. The minimum base premium with Guardian. Remember where we said the death benefit's going to be high initially? $3.5 million. That's high, by the way. The base premium, not quite at 7,500, 79 and change, almost $8,000. Why it's higher is going back to the point we mentioned earlier. Funding 20 years with Guardian, that's tough to still have a 10% minimum premium. That's as low as we could get it with this product. The death benefit is $3.5 million. The whole life death benefit is 10% of that, which is literally as low as the company will allow us to set it. And why that death benefit is so high is because we attached a term insurance rider that would last 20 years with the funding that he's considering. Because if you don't have that term rider attached, then he won't be able to add the dollar amount that we see here unless he just really increases the base premium, which forces him to a higher minimum commitment. Looks horrible. If you wanted to see it, we would show him it. Some people ask us to see that, but it doesn't look good. Let's put it that way. Then we've got a different version of that same Guardian product. This is just a higher PUA fee, which has more money long term. And then a Mass Mutual product, specifically their high early cash value policy. 75 for 10, followed by $50K per year thereafter. There's a 10% minimum premium. And with the way you could set up MassMutual, check this out. The initial death benefit's about half, but wait until you see what happens long term. All companies have their advantages and disadvantages. And we're looking at just two here. But this is where you want to know the rules of the game, baby. So we can see everything side by side, have it explained to us in a manner that hopefully is simple, and we don't say, Steve, what are you talking about? And then pick the option that allows us to use the product to the fullest. Here is the first Guardian option we looked at. We've got the minimum at 10K. The reason why, because the true base premium was just under 8K. If we go back to this, the all-in minimum is the base plus the cost of the term rider. So when you add them up and round off, it's 10K. That's where we came up with that. So all-in minimum, about 10 grand. Rest going toward PUAs for the total funding. 75 for 10, 50 per year thereafter. There you go. So this is Guardian's L95, 5% PUA fee. What is highlighted in yellow between years 4 and 5 represents the break-even point. He's breaking even almost year 4 in this example. This example has a very high amount of liquidity up front. Long term, however, it will be the weakest. If we compare it to the same product, but with their 10% PUA fee, which is structured in a manner where the company is taking more of your PUA payment up front, which means you get less cash value up front. You have to wait longer to break even. It's year 6 here by the time he's positive. That's what you give up. But long term, you've got more potential. Look at that. About 50 grand more by year 20. If you look at it at the bottom, year 30, you've got 2.94 with a 5% PUA fee and 3.164 with a 10% PUA fee. So long term, this one satisfies what he's looking for, more money long term. Where he mentioned less liquidity up front in exchange for the potential of having more long term, if he likes Guardian with that PUA flexibility, this option I think would work quite nicely for him. And how it would work is he could set it up in a flexible manner where he's only billed for this, so he gets a bill one time per year for 10 grand, or he pays that monthly, and then PUAs he adds at his leisure. That's the advantage to Guardian. It does not satisfy the minimum death benefit up front though. But if he says, hey, if it's all the same long term, but I have more death benefit up front, I'm good with that, that works. But look at Mass. I love Guardian's PUA flexibility. I really do. But whenever we speak with someone who's interested in funding a policy with a minimum premium and for a long period of time, Mass is going to look good, like they are, because I can start that death benefit much lower. MEC limit's close to 75K. The base premium is 75 plus the term. All-in minimum is about 9 grand. Rest can go into PUAs. There's your annual funding at 75. First year cash value with this specific product. Look at this. You're over 90% of what you paid in first year cash value. Your break-even point, year 4. So a lot of liquidity up front, a low minimum premium, and the ability to fund for a long time. You can go for 30 years. You can go for 40 years with this option actually with the same design. I might have to make a slight adjustment to the death benefit and term rider, but you could do that. So there's the funding, looks good. Now, long term, if we compare the center example with the example to the right, MassMutual will look better, but I would argue that they've got a higher dividend at 6.4% being illustrated compared to Guardian at 6.1. I see stellar results with Guardian and Mass. We track them both in terms of the actual results. Can't really go wrong with either of them, in my opinion. But the flexibility is different. Like, here's how I would honestly look at it. If you like the low death benefit up front and how it increases over time, you like the high liquidity up front without sacrificing it long term, and here's the big thing, you're comfortable with a one-time per year PUA payment adjustment, meaning you're starting with $75K off the bat, and next year you're comfortable with 75. And if you're not, you're comfortable adjusting it down on year 2, and then when year 3, or I should say before year 3, if you want to add more, you're comfortable not doing so and waiting until year 3 where we can scale the PUA payment back up. If you're comfortable with that over the life of the policy, Mass works well. If you said, too strict, I don't like that, what's an alternative? Guardian. Trade-off based on your goals, higher death benefit up front, larger term insurance rider cost. Advantage, you can set it up where you're only billed for about $10K per year. That could even be broken up over 12 months. And then at your leisure, you can just pour extra funds into the policy whenever you want. So now you've got a very flexible policy. So usually, that's what we'd like to do in terms of walking you through the different options. Does that make sense? And then the next step would be showing you how you could use the policy in terms of loans and such. But in this particular case, that's what we showed him. The different options, companies, and products, and that is a small sample of one of the things we like to do for the people we work with who are doing a lot of research, but they're trying to get everything right. So options help. They help me as long as it's not overwhelming and it's explained in a manner where I feel comfortable. So I hope you enjoyed this video. If you did, please let me know in the comments below. If you have any questions, feel free to let me know as well. If you'd like to connect with us, feel free to visit our website, ibcglobalinc.com. You can also DM me on LinkedIn, or if you visit our website on the Contact Us form, just say, hey, Steve, would love to connect. I do look at all of those messages that come through up until now, the date of this video. But anyway, feel free to reach out anytime. And as always, I hope this helps.